Just the other day, somebody asked me what stocks they should buy in the stock market, what they should do during this stock market crash. And I replied, you should look for stocks that have been strong in the past, stocks that are very important to the overall economy in terms of people using them, buying them, and companies are really just in the spotlight. Let's look for really popular companies that everybody uses every day. You know, things like Starbucks and companies that people can't live without. So no matter how bad the economy gets, even if it gets to a point where the world's ending, people are still out there trying to get their Starbucks coffee. Gotta talk about why it's very important to diversify during this time. Make sure you're not buying 5 stocks in the same exact sector and exposing yourself to massive risk for no reason. I'm gonna talk about that here in this video, so make sure you guys stay tuned. What's going on? Like I said, I had a friend of mine. He called me. He's like, hey, I know you're into the stock market. I know you know about stocks. And I said, well, I'm definitely not an expert by any means. But if I was going to invest in companies today, if I was going to be buying a stock, I would look for stocks that were strong going into this crash. So basically, I'm looking for stocks with an upward trajectory in 2019 and the beginning of 2020. Also, I'm looking for stocks that are beat down because of what's going on in the world with the pandemic and stocks that are really taking a beating. And I'm looking to buy those stocks for a long-term hold. But let's get this very straight here. I am not looking to buy 3 or 4 companies in the same exact sector. A friend of mine, he put $10,000 in only cruise ship companies. He bought 4 different cruise ship companies. When he showed me his portfolio, I slapped myself in the face and I wanted to just jump out of the boat and swim away because I did not know what to tell him. Why would you buy 4 of the same exact companies, basically? 4 of the same exact companies that are exposed to the same exact issues right now. That is a terrible idea. So he put $10,000, one Royal Caribbean, Carnival Cruise Line, Holland, and I looked at the portfolio, and at that point he was down $4,000. And guess what? This is what he did as well. He bought the last rip. He bought the last bounce. He bought Royal Caribbean and stuff at like $40 after it went to 20 and then bounced to 40 and now it's back at 20. And I'm like, you're doing exactly what you should never do as an investor. Number 1 rule, if you're going to be investing long term, there's no rush. There's no reason to jump into anything. You know, if you're just overly excited, you got FOMO, well, just don't do it. I told him, this is the plan for here on out. This is what you should be doing. If you're investing long term, you should be saving money for a big red day. I don't want to buy any stocks that are up green on the day. I'm looking for stocks that are pulling back, 5 or 6% on the day. I'm looking for stocks that are crashing on the day. I'm looking for an opportunity to buy at a discount. I'm not trying to buy at a premium. I'm not trying to buy a stock that just went from $20 to $40. I understand the idea of FOMO. I do. Trust me. But why would I pay a premium for a stock that was $20 just a few days ago and that bounced from 20 to 40? Tell me why I would do that. That makes no sense. That was my first advice. Never buy any stocks that are green on the day. Why do it? It's the same idea with crypto. When I buy crypto, I never buy crypto when it's green on the day. I wait for a red day. Now the thing here is, I understand, again, FOMO, right? You get the FOMO. There might be, 2 or 3 green days. It's like, wow, the market's going up. I want to buy. But I guarantee you, I promise you, I can pretty much 100% promise you that there will be a red day. Even if, Royal Caribbean goes from 20 to 40 and then to 60, there will be a red day. It will pull back at some point. It won't go from 20 back to 400. It's going to go like this. It's going to go, brr, 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 and then, have some pullbacks along the way. So that's one of my biggest rules I tell anybody who's investing. If you're going to be investing long term, wait for a nice red day. Why pay a premium? If I can buy a stock 6 or 7% lower because, the market's just pulling back overall, why would I buy that stock when it's up 10 to 15% on the day, which he did, which made absolutely no sense to me other than the fact that this is what beginner traders do. They buy stocks that are going up because they think it's going to keep going higher. So they buy at the high, they sell at the low. How many people out there do you know who have bought a stock at the high and sold at the bottom and then watch the price go back to where they bought it at? This happens over and over. So again, why buy something that's just went from 20 to 40. That makes no sense. So wait for a red day. Why buy 4 stocks in the same exact sector? These stocks are following pretty much the same exact patterns. Why expose yourself to 4 companies who have pretty much the same exact charts? It makes no sense to me. I would rather buy 1 cruise ship company, maybe 1 airline, maybe 1 food company, 1 tech company, 1 clothing company, 1 industrial company, 1 maybe insurance company, things like that. I want to diversify. I want to be in multiple sectors. So that way, guess what? Let's say the cruise ship lines go to 0. They go bankrupt and there's no more cruise ship companies. Well, at least I didn't have all of my money in the cruise ship companies only. Why would I put $10,000 in only cruise ships? I could put $2,000 in a cruise ship, $2,000 in an airline, $2,000 in a food company, $2,000 in, something else. So why would I not want to diversify? I understand. I understand the idea that, okay, I'm going to put all my money in the cruise ships and I'm going to look for a big bounce because I think that I'm going to get rich here. And I understand that idea. But why expose yourself to 4 companies in the same exact sector who are all facing the same exact headwinds? I'm going to look for different opportunities. So maybe the returns won't be as great. Maybe if I'm buying like Walmart, I don't expect 100% return. That's totally fine. Maybe if I buy like Nike, I don't expect 100% return. But I'm also not expecting that Walmart, Nike, Target, these companies are all going to go bankrupt. But if I'm buying 4 cruise ship companies, there's a chance that 4 of these companies could go bankrupt. So my $10,000 that I put into these companies, and I know firsthand what it's like to buy stock in a bankrupt company. It's not a good idea. Pretty much, if a company is talking about bankruptcy or talking about how they can't stay in business, I'd be very careful investing. Because and then this was the other thought process from my friend. He said, well, I put $10,000 in, I'll put another $10,000. I'll just buy when the stocks get lower. And I said, that's not how it works. You can't just keep buying as these stocks go lower. So let's say you bought at $40 and now you're buying at $20, and then a week from now the stock is $10 and then it goes to $5. It doesn't matter if you keep averaging down. It's going to get to a point where you're not going to have any more money to average down, and it's going to be much harder to lower your average. So if you bought at 40 and you buy at 20, well, now your average is 30. So you're still in the red. Now the stock price is 10, so you buy at 10. Now your average is like $25. See what I mean? It makes it much harder to average down. To keep averaging down is not a solid play. Now, obviously, I understand that he's investing long term. He'll probably end up okay here. He'll probably end up, making some money in the long term. But why expose yourself to 4 different companies that all have the same exact exposure to the same exact issues and the same exact problems? There's no reason to do that. So number 1, diversify. Number 2, make sure that you're buying on a red day. I understand. Again, I know FOMO. Everybody gets all excited. The market's green. The market's going up. Well, guess what? The market pulled back. The market went up. The market pulled back. The market went up. The market pulls back. That is how the market moves. So there is no reason to buy a stock that's up 10, 20% on the day. There's just no reason to do that if you're holding long term. Because even if that stock goes up 10% and then up 20%, it's still going to pull back. Maybe 5, 6%. That 5 to 6% pullback is going to be a much safer, a much better entry, a much better cost average. So please, if you're going to be investing long term, just wait for a nice red day. There's going to be more red days to come. Even if people believe that the market's going to go like this, like a V, and they're like, oh, the market's going to crash, and then we're going to rally back, there's still going to be some red days along the way. And again, I hate to say I can promise you that, because I can't promise you that, but I can tell you from experience, every time that I went and got all excited, I got FOMO and I bought a stock that was going higher because I thought I was going to keep going higher, it always pulls back. It always pulls back. It's just how the market moves, because people buy at the top and they sell at the bottom. This is not rocket science. People do this over and over. This is the mindset. My friend, if there was a Wikipedia page that had retail investor on the, for like, what's a retail investor? It would have my friend, it would have his picture, and it would have him smiling like this going, I bought $10,000 worth of cruise ship stocks, and now I'm down $5,000. Oh my gosh. Like, that's what blows my mind, is just how bad that was, how bad of an idea. And what's even funnier here is that he asked me about what stocks to buy when all those cruise ship companies were down in the 20s that were, we're all crashing. I said, well, if you really want to get long, you want to buy something, look for a cruise ship company. That was back when Royal Caribbean, when these companies were in the 20s. So what did he do? He waited till the price got to 40, he got excited, and then he bought. He bought it at 40, and then it crashed back to 20. I really, really just hope that this video out there reaches somebody, that you guys don't make the same mistake if you're going to be investing long term. Don't buy the rallies, buy the dips. Buy the dip, sell the rip. Buy the dip, sell the rip. Buy the dip, sell the rip. Do this, do this, do this. I'm telling you. Please, please listen to me here. If you've never listened to anything that I've ever said on this channel, do one thing for me. Buy the dip, sell the rip. There it is. If you're going to be investing long term, why pay a premium? And also, please diversify. Buy multiple companies in different sectors. That way, if Starbucks goes back to the moon, you make some profit. That way, if the cruise ship companies go to zero, you don't lose everything you got. There's no reason to have all your money in one sector. Even though I understand that there, the possibility of, wow, the cruise ship companies are so beat down, they're going to rally back. There's going to be a long, tiresome, gruesome, it's going to be very, very rocky road for the cruise ship companies, for airlines, and all these companies moving forward. So please, don't put all your money in one sector. Don't do it. Don't do it.